Welcome back to RealPage Economy Express. With a clear flow of delayed data finally arriving, we're getting a better read on the direction of jobs, housing, inflation, and monetary policy. Let's jump right in. We will start with the labor market, where the latest payroll report reinforces the slower pace we have seen for much of the year. Employers added 64,000 positions in November, and the unemployment rate held at 4.6%. Healthcare and construction led job creation, while federal government payrolls continued to decline. Average hourly earnings rose modestly in November and are up 3.5% over the past year, a sign that wage growth has cooled but still outpaces inflation. Staying with employment, weekly unemployment claims add another layer to the story. Initial claims fell to 224,000, and the insured unemployment rate stayed at 1.2%. Turning to housing, we continue to see gradual movement rather than major swings. Existing home sales edged higher by 0.5% in November, marking a third straight monthly gain powered by lower mortgage rates. Inventory tightened and price growth remained modest but positive, which suggests stability rather than a surge. Alongside that, the mortgage market is reacting to year-end seasonality and rate expectations. Total applications fell nearly 4% last week. Purchase activity declined, which is typical for late December, but remains above last year's levels. Refinancing dipped slightly as well, but still shows strength compared with a year ago. The average 30-year mortgage rate firmed to about 6.4%. Shifting to consumers, sentiment is still cautious but has improved somewhat. The Consumer Sentiment Index was revised to 52.9 in December, up from November. Expectations saw more progress than current conditions, and year-ahead inflation expectation eased to 4.2% from 4.5%. That is the lowest reading in nearly a year and marks a fourth consecutive monthly decline. And on the inflation front, the direction continues to be encouraging. The Consumer Price Index rose 20 basis points over the last 2 months and 2.7% over the past year, down from 3% earlier in the fall. All of this sets the backdrop for the Federal Reserve's latest move. Policymakers delivered another quarter-point rate cut, but a divided vote signals a slower path ahead. The funds rate now stands between 3.5% and 3.75%, and the Fed is pausing balance sheet runoff while resuming Treasury purchases, signaling patience rather than urgency. Stepping back, we're looking at a labor market that is cooling gradually rather than weakening sharply, housing activity stabilizing rather than slumping, inflation drifting lower, and a Fed that is shifting to a more patient stance. We'll track the next round of data as it arrives. See you next time on RealPage Economy Express.